Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. This is a continuation of last week's show when I was getting into year-end tax strategies and we were discussing IRAs, and I want to get back into that discussion on some actions you may want to be considering between now and the end of the year. I was getting into some Trump tax proposal issues on benefits we may lose after the end of this year if the tax proposal next year goes through, or even goes through this year effective next year, which I find unlikely, but who knows. So what our discussion was ending up on last week was where I'm going to pick up this week on the IRA discussion, traditional IRA versus Roth IRA. And the issue is everybody wants a traditional IRA all through their working years. And then they want a Roth IRA by the time they're retired. The reason is, and we can't have both at the same time. The reason is the traditional IRA, we enjoy an income tax deduction on our income tax return every year we make an IRA contribution to a traditional IRA. It completely erases that amount from our income that would otherwise be taxed. So if I make a $6,500 contribution and my spouse makes a $6,500 annual contribution, that's $13,000. If I'm over age 50, I'm allowed to do that. If I'm under age 50, I can only do $10,000. Well, actually, it's 11 now. So you look at that and you say, both of those numbers are big. Does that mean $11,000 of whatever our income was last year is subtracted and we don't owe tax on $11,000 of our income? Yes, that's exactly what it means. If you're over age 50, it's $6,500 each, which is $13,000 erased from your income. It's not taxed. That's huge. Even if you're in a 15% bracket, that's almost $2,000 saved on your taxes. That's a $2,000 check to you on your refund. That's huge. So you look at the traditional IRA and you get that every single year, that benefit. So the benefits are all up front. The penalties are all in arrears, because what happens is you get the income tax deduction up front as the carrot to do the program into the IRA, which again, a lot of people think IRA means individual retirement account, but it's not. It's individual retirement arrangement with the IRS. So in order to play along with this arrangement, the IRS gives us a carrot and a stick. The carrot is, come on in, Johnny, and play with our IRA here, and we'll give you an income tax deduction every year on new money in as you contribute more and more. Isn't that nice? And you say, what's the catch? There must be a catch. It's too good to be true. And the IRS, the big bad wolf, says, oh, there's no catch, Sonny. All you do is you take the tax deduction now and you pay it to us later when you pull the money out. You say, oh, okay, that doesn't sound too bad. I'm postponing it. And you say, what happens to all the gains along the way? And the IRS says the gains stay tax deferred also, and you only pay tax on those way later in the end when you take the money out. Well, boy, does that build as a snowball into a huge tax time bomb. So the Roth IRA is also IRS approved. And the IRS says, in order to play that game, that's also carrot and stick, but it's in reverse. They hit you with a stick first, and they say any amount of money you put into this Roth IRA is not tax deductible. So wherever you got that money, you will have paid us tax first. Whatever's left is yours, and if you want to put it into a Roth IRA, knock yourself out. And you could do the same limits, $5,000 or over age 50, $6,500. So now you have the same $13,000 going into the Roth. It builds up to exactly the same amount, folks. If you put $13,000 into a Roth or $13,000 into a traditional IRA, it doesn't matter. If you put them into the same investment company or whatever you're doing, you're going to have the same result inside that account. Neither one throws off 1099s. Neither one throws off different forms of taxation all along the way. They're both tax deferred. So as long as you keep them in accordance to the rules, let's leap forward, and you're now age 70 and a half. Now, one of you has $1 million taxable IRA, a traditional IRA. The other one has a Roth IRA, which is totally tax-free. There are a number of differences, the first of which, 70 and a half age is extremely important for a traditional IRA and not at all important for a Roth IRA. Here's why. A traditional IRA requires minimum required distributions, MRDs or RMDs, different institutions reverse the words. You're required to start taking out of a traditional IRA and paying tax as you take those distributions based on your life expectancy tables. So the IRS calculates how much you have to take out every year and pay tax on. So you start losing the tax on those contributions. The Roth IRA, and by the way, that income does hurt other areas on your tax return. The Roth IRA, on the other hand, does not require required minimum distributions at 70 and a half. That means you're not forced to take income on your tax return, even though it would not be taxable. It can sometimes affect other areas on your tax return, taking any income. It can even knock you off some, PACE programs or whatever programs you might be on that are subject to any limit from anywhere income, because you don't have to take it at all. It can stay in the Roth. So here's what happens. That Roth builds up and it's still tax-free. Well, you'd say, well, what happens when I die? I have someone with a traditional IRA on the one hand. Let's say it's still $1 million. And I have a Roth IRA on the other hand. And let's say it's $1 million. We haven't tapped either one yet. And I'm still 70 and a half and then pass away. The heirs, let's say the kids, because the spouses inherit differently. So let's go straight to the kids. Either the first or the second death, it gets to the kids. The kids are entitled under today's tax rule, 2017, to employ what's called a stretch beneficiary inherited IRA plan. And what that means is a traditional IRA, which would otherwise, all the money would be taxable, in full, upfront, or no longer than within 5 years of the date of the inheritance, be fully taxable. That would force you into an extremely high tax bracket if that IRA is large enough in value. So you're a doctor's son or a doctor's daughter. I don't mean a doctor's son or daughter. I mean you're the doctor's son or the doctor's daughter, and your income, you're looking for every way to avoid income tax already. And then you get dumped this inheritance IRA, you're almost tempted to disclaim and say, I don't want it, which of course would be foolish, but the tax nightmare of inheriting it is that severe. So what happens now, you're entitled to the stretch IRA. It's wonderful. The stretch IRA means you can inherit the $1 million IRA, and all the IRS imposes on you as an heir by setting this process up as a stretch beneficiary inherited IRA is that starting the year, by no later than December 31st, the year following the year of death, you have to start taking out a required minimum distribution based on your whole life expectancy table. So you might be 45 years old or 48 years old. Life expectancy table is 85. You might have 40 years life expectancy still, which means you only have to take out 1/40th of the plan. You're talking about 1 or 2%. $1 million, you're only talking about having to take a required minimum distribution of 1 or 2% of the account. The account may be earning 4, 6, or 8% depending on how you have it positioned. So while you're taking out some, it may be earning more than you're taking out. You're never depleting the asset. In fact, it's still continuing to grow. And in fact, the beneficiary IRA is allowed to happen on one future generation. So I will let you know this. If you're not being told these things and you're hearing them for the first time on the radio or seeing my videos or seeing them on TV, Bethel Park Public TV Access, YouTube, wherever you are seeing this, call our office and get some planning done, because these are strategic issues that are very important. The reason I skipped the spouse in my example was on purpose. If a spouse inherits an IRA, based on what I just told you, you would think the spouse, and most advisors do, think the spouse is supposed to establish a beneficiary IRA. And that is horrible advice. That is not what should happen. The beneficiary IRA rules allow one beneficiary level to receive the stretch, and then even one more upon their death. Now, what's the problem? Here's the problem. A spouse has special benefits all along their own by being a spouse of a deceased IRA holder. And that benefit is this. Every married spouse has the ability in the tax code to receive a spousal continuation IRA and receive that IRA as if it was their own. That is only to a spouse. That benefit only pertains to a spouse. What is that benefit? Spouse gets to have it as if it's their own. If they're 55, they don't have to take RMDs because it's as if they're own. They don't have to take RMDs till they're 70 and a half. Okay, they're over 70 and a half. They have to take RMDs. What's the difference? Here's the difference. Because it's not coined as a beneficiary IRA, they haven't implemented a beneficiary IRA process on that money yet. So the deceased, let's say the husband, the wife is the spouse, she's the sole beneficiary, she inherits, she takes it as a spousal IRA, inherits it on her own, as if it's her own. Even after she's 70 and a half, she's taking all the required minimum distributions, just the same as she would had she done it wrong as a beneficiary IRA. So what's the problem? The problem is you can only go down 2 layers, 2 levels on a beneficiary IRA. You can only do it twice. If the money goes straight to the spouse, she receives a spousal IRA with the same benefits, even better actually, because she doesn't have to take RMDs until she's 70 and a half, unlike an heir on a beneficiary stretch IRA. And when she dies, the kids can do a beneficiary IRA, level 1, and their kids, which are the grandkids, can also do a beneficiary stretch IRA, which is level 2. So we've stretched it out actually 3 generations, where when they mess it up and they go to the beneficiary IRA for the spouse, they lose one of the levels, and now only the kids are the final level because that's level 2 of a beneficiary stretch. So don't make these mistakes. This is a very complicated industry. This financial planning is tough. But as you could see, there are so many moving pieces that properly coordinated can be such a powerful opportunity for you. And even I have to look things up. I look them up every day. I'm always researching. But the key to that is because I don't know everything, but I don't pretend to. All I do is try to share all the different opportunities, and then whichever ones are applicable, we go to the tax return and we see, like last week, what's the RMD, what's the Roth contribution limit, what's the income limitation where you're phased out, all that. I have to go research that too, just like everybody else. But the key isn't knowing what the limits are. The key is knowing that there is a limit. So we say, are you eligible for Roth? Oh, sure, sure. No, that's wrong. We know there's a limit. We just have to go look it up. We don't try to keep all that in our head. We do try to keep all these strategies in our head. A certified financial planner is what I am. The designation means something. It's hard to put all these pieces together, but wow, how valuable. So we're near year end right now, and you're deciding, should I contribute to an IRA at all? And I'm here to say, look at the tax returns. We need to look at those tax returns to see annual contribution to a Roth we lose the tax deduction. But then at 70 and a half, you're home free. There's no required minimum distribution at 70 and a half. You could just keep that thing growing forever. And then you get to next year, and the next year after that or whatever, after you pass away, the kids get to do a stretch on those Roths. And guess what? It's tax-free to them. It's all tax-free to them too, the same way. Now, back to what started this conversation in the prior show. Why did I even get onto these IRAs? Because I was talking about charities. And I was talking about the Trump proposals. And guess what? There are changes. There are potential changes. Number one, there's a proposal that in order to do a stretch IRA, if this tax plan goes through, maybe trying to limit amounts over $450,000 in an IRA cannot be stretched. Ouch. I'll bet you're not even seeing anyone talking about those types of proposals being talked about, but it's huge. Here's another one. Last week I said maybe if we can't contribute to a Roth because our income's too high, our annual income earnings are too high, so we're not eligible to fund a Roth, even though we want the tax-free benefits. Well, we have the ability to convert $1 million IRA into a Roth IRA, either all at once over 4 or 5 years, whatever we want to do. We convert that, and what it means is we pay taxes on the whole $1 million, or if we only did $200,000, however we want to do it. We're not cashing the IRA out, remember, and then writing a check to the Roth. The money has to go directly from the traditional IRA to the Roth IRA institution, has to go directly, untouched by us. But when that $200,000 goes there, we have to pay the income tax. So you better have $40,000 or $50,000 laying around if you moved $200,000 over, because you can't take it out of the Roth and you can't take it out of the traditional IRA. You have to take it out of somewhere else. And I say can't loosely because you could, but it would be devastating. It would ruin the plan. So you need to have 20 to 40%, whatever your tax rate is, sitting aside to pay those taxes from another source. And let's say you do. There's nothing wrong with that. Somebody's going to pay it anyway. Maybe not at that same tax rate, but that's your strategy there. So now we've paid the tax. And let's say we had $200,000 into the Roth, and now we lose $50,000 out of our checking account or wherever else we had it. So we lost $50,000 to tax that we were going to lose anyway, or our kids were, don't forget that. Now, the tax proposal. We were always able to, I say always, the last 10 to 14 years or so, if we converted from an IRA to a Roth IRA, paid the tax, we could actually file an extension and do all kind of wacky things and wait until October of the year following the year of conversion and undo the IRA conversion to a Roth if we felt like it. Why would we do that? Okay, stock market's at an all-time high. I employ this genius strategy that Driscoll told me to do, and I moved $200,000 over. Let's say I moved a whole $1 million over, and we paid 40% in income tax. Now, 39.6. $400,000 is gone if we do that, which would be very unlikely that we would do that. I have $1 million in the Roth, that's true. I don't only have $600,000 there, I have $1 million. But I lost $400,000 because I had to pay the tax from one of my other mutual fund accounts, or I had to sell a property or whatever I had to do. Now I lost $400,000 in tax. We would have paid it anyway, but not at $400,000 at a 40% rate. We might have paid a 15 or 28% rate. So it would have been less, let's say, theoretically. But let's now look at this. Stock market crashes the month after I make the contribution, or 6 months after I make the conversion, I should say. It's not a contribution. I make the conversion. And now my Roth IRA, which was invested exactly the same, I duplicated and replicated exactly how it was invested. markets fell like they did in 2008, and I lost 2/3 of my value. My Roth IRA is not worth $1 million now. My Roth IRA is worth $450,000. Let's say, for example. I just paid income tax on $1 million, and I have an account worth only $450,000. Had I not rolled this over by converting it to a Roth, I should have waited until the markets fell. I would have only paid income tax on $450,000, and all the shares would have moved over to a Roth. Then I could just wait for all the shares to come back, if they ever do, to be again worth $1 million, and they'll have grown inside the Roth, and I'll only have paid tax on $450,000 because I'll have waited for the crash in the IRA and then take it out at the dip. Well, that's interesting. So now we look at this strategy, and I know most of you aren't even being talked about these strategies, so I don't know where your advisors are that they're not talking about these, but that's why I'm doing these shows, to share with the world. Look at all these strategies that we're employing with clients and are able to be employed that you're just missing out on. Whether they're applicable for you isn't the important thing. It's that whether they're being addressed for your portfolios and to figure out how to maximize what you have. So let's take, for example, we should have waited a year. You say, oh my goodness, what a royal mess up that was. What a waste. The IRS code today says, don't worry about it. You have up till October the following year. If they crash, you could put the money back into the traditional IRA and we'll give you the tax money back. You say, what? Yeah, we'll let you undo it. We'll let you undo the whole thing. So you've got to be kidding me. This is the IRS, right? This isn't a scam, call, and they say, no, we let you do it. It's called a recharacterization. You say, what? It's called a recharacterization. So by October, I can move the money back into the traditional IRA and undo the whole thing and get all my income tax back. And it's now worth, it would have been worth $1 million, but it's now only worth, okay, fine, we're wonderful. We can put it all back in. Guess what? Those opportunities may go away because the Trump tax proposal has wording in it that says they may get rid of or reduce or eliminate or whatever the recharacterization of a traditional IRA into a Roth. They may take that strategy away, which means now we are taking that risk if we convert and the markets crash. So, do you see what I mean now that we're at year end? We're in one tax code. We might be in another one starting January 1st. Even if the tax code is not passed till October of 2018, it may be retroactive to January 1, 2018. So we're only a month away from maybe losing some of these strategies and seeing if they're appropriate for you or not. Gifting strategies to charities. We have a whole lot of them that can come from the IRAs that I told you about last week. Conversion to Roth, recharacterization, huge. Now, let's get into another one. We're at year end, and I still want to talk about these charities. I have a lot of people always ask me every single year, how much are we allowed to give? Right? You hear that too. How much can we gift every year? How much can we gift? As if whatever number you're told is all you're allowed to give. It's all you're allowed to give away. That's not true at all. So when you ask me the question, how much are we allowed to gift per year? I'm going to tell you whatever you want, however much you want. You're allowed to gift as much as you want, everything that you have and more. If you're smart, you'll say, well, that's not what I meant. I didn't mean to ask how much am I allowed to gift. What I meant to ask is, how much am I allowed to gift without incurring any taxes to anyone? And I'll say, oh, well, that's a different question. So what you're referring to is the annual gift amount exclusion. And that is the amount today, used to be $10,000 a year for years. Some people still think it is $10,000 a year, but it's been incrementally increased. For 2017, it's $14,000 a year. is the amount you're allowed to gift from any one person to any other one person without having to file a gift tax return. That's what that means. Next year, it's supposed to go up to $15,000 per person. So if you'd say to me, all right, I don't want to file a gift tax return, right? I'd say, well, it depends. How much are you worth? They'd say, what do you mean? I'd say everything, add up everything you have, your 401ks, your IRAs, your real estate, your cars, everything that you have, savings accounts. How much have you accumulated over your life that's still stuck to you? In other words, what do you still have of all that money that went through your hands? You might say, I have $4.5 million. I'll say, are you married? And they'll say yes. Or they'll say no. Doesn't matter. $4.5 million, and I'll say, fine. You're under one of the radars for a federal estate tax will not apply to you. Unless, and get this, a lot of people forget this. Let me ask you another question. I'll say, do you have automobile insurance? Do you have car insurance, homeowners insurance? They'll say, yeah, what's that have to do with anything? And I'll say, probably nothing. And I'll say, do you have long-term care insurance? And they'll say, yeah, but what's that have to do? Well, probably nothing. I'm just getting my notes. Do you have any life insurance? Yeah, I have $2 million life insurance. Now, what's the difference? Bingo. You were $4.5 million, and when I asked you everything you're worth, nobody asked you about your life insurance. The day you die, that is a created asset that doesn't exist the day before you die, which is the death benefit. It's only worth the cash value right now. So I say, what's your worth? You didn't even think to tell me about the cash value, let alone the death benefit. You have a $2 million death benefit. You're married, you're worth $4.5 million, but when you die, you're worth $6.5 million, or your spouse is, if she's the sole beneficiary. And now we do have a federal estate tax, and we were about to make a huge mistake back then when you asked me that simple question, how much can I gift every year? See how complicated this gets? And now the difference of over $1 million is taxed at about a 40% tax rate potentially. You lose $400,000 of a $2 million life insurance policy because it's included in your estate if it's done, I'll call it improperly. Or we could split the estate a little bit because here's the exemption. In 2017, any one individual has a federal estate tax unified credit of $5.49 million each. But if I die and my wife inherits everything, she does get it federal estate tax free, but not inheritance tax free. Well, yes, she does. If you're in Pennsylvania, she gets it inheritance tax free also. So she's now worth what? $6.5 million. And then if she dies, her exemption limit today is 5.49. So now the kids have a little bit of a federal estate tax problem. Well, next year that's about to change possibly, because it looks like we might go to 11.6 million per person. If we get there, now that eliminates some of that federal estate tax risk. So what I'm going to do, we're out of time for today. I'll come back again next week and I'll expand on this discussion, especially near year tax end here, where we're looking at these strategies on gifting, year-end gifting. What are we allowed to do? What aren't we allowed to do? And how is most efficient? So I appreciate you tuning in, everyone, to another edition of All Things Financial. I'll be back again next week to continue where we left off today. Thanks for tuning in.